Okay, so all right, as promised during the last webinar, that we're going to do have a recorded video of that webinar, but unfortunately, the webinar has a lot of distractions, and that's why we've decided to do a neat video that is devoid of any distraction, so that we all can also understand what we did during the webinar. Alright, so here we've got to do a simple financial model. It's at the basic level. So here we'll be looking at the structure of the income statement, structure of the balance sheet, structure of the cash flow, finding the cash, and also establishing and audit a balance sheet check on our balance sheet to show whether it balances or not. So here we've got the inputs that will drive the model. So the first thing when building a model is to establish assumptions around each line item in your model. So we have income statement line items, we have balance sheet line items. So you need to establish um, assumptions regarding them, looking at the key performance indicators like sales, like cost of sales, like selling expenses, like taxes, like finance cost, and the rest of it. So you need to establish their dependent variables in the income statement or the balance sheet, such that you'll be able to establish this assumption. Alright, so here the sales have been forecasted to be a yearly sales growth of these rates yearly. So this is a year-on-year growth forecasting method. Then we have cost of sales expressed as a percentage of sales. Then the selling as well as a percentage of sales. So we are going to be multiplying these percentages with the sales figure because it is expressed on sales. Alright, then we have taxes, percentage of profit before tax. So that's it for the income statement assumptions. Then we've got balance sheet assumptions, which is the current asset is also expressed on sales. Then we have fixed asset to be the Naira growth, which means the purchased assets during the period are this. Then current liabilities is expressed as a percentage of cost of goods sold, and so we are going to apply these rates on cost of goods sold. Then long-term debt is a yearly balance, so this will be the balance at the end of the year in the balance sheet. Then we've got the share capital, the Naira value. So as well, this will be the value, the Naira value of our share capital in the balance sheet. So these are the assumptions that will drive our model. So let's go look at, so this is the input to the model, the inputs and assumptions. Then you also need to have a calculations, but here because it's a simple model, calculations and the output have been embedded together. So we've got our outputs to be profit and loss, another output is balance sheet, another output is cash flow. So let's see how to forecast our P&L. So in forecasting, the first step is that you should ensure that your historical periods balances. So if you take 5 years historicals to forecast your 5 years financials, then you need to ensure that those 5 years historicals are balanced, or else you can't forecast because your forecast will also be in disagreement. So in this case, we have just one historicals, the base. So we need to ensure that this base is in agreement by getting all the totals. So the totals for P&L as well as balance sheet. So we need to ensure that our balance sheet balance for this base here. Alright, so let's go ahead to get the total, the gross profit here. So the gross profit will be equals to sales minus cost of sales. You've got that. Then operating profit will be equals gross profit minus selling expenses. You've got that. Then our net income, because here we don't have finance costs, so our net income, which is the same thing as net profit, will be operating profit, operating profit being the earnings before interest and tax. So that will be, you subtract the taxes from there and you get your net income for the base. Then you go to your balance sheet and you do likewise for the base. Ensure you get the totals for the base year. So total current assets will be our cash and current assets. So I'm going to sum that total using sum. Then we go to total asset. Total asset will also be the total current asset plus the fixed assets. So I'm going to be summing that as well, so that we can have just one single formula with that. So this total current asset, and I'll put comma, and the fixed asset. So we've got the total of 10,233. Then the current liabilities plus the long-term debt will give us our total liability. So we'll sum that as well. So I'm going to start with current liabilities, then comma, then I go and include the long-term debt. So we'll move to equity. Equity is share capital plus retained earnings. So I'm going to sum that as well, and you've got that. Now we need to also have our total liabilities and equity. So total liabilities and equity, I'll start with total liabilities of 6537 and my total equity of 3696. So that gives me 10233. Alright, then we need to do a balance sheet check here to audit what we have done, and that will be to say total assets minus total liabilities and equity, and that gives us 0, meaning that our balance sheet is in agreement. So this is the first step. For the cash flow, you don't do calculations for the base period, because you are going to actually forecast the cash flow using the P&L and the balance sheet. Alright, so let's move into the next step in forecasting a company's financial. So the next step, after ensuring that your base case is balanced, like we see in this balance sheet, that our base case of this column is balanced. When you go through down, you see you have nil. Alright, so since that is done, the next step is to make forecast for the first year, concentrating on the first year, leaving out the other years. Even if you are forecasting for 10 years, 30 years, you ensure that your forecast for the first year is balanced first before you go look at the second year. Alright, so we are going to do the forecast for P&L balance sheet for only the first year, concentrating on the first year. If the first year of the forecast can balance, then the other years can also be balanced. Alright, so let's start with forecasting for sales. Sales for year 1. We need to go check what the assumption is, but first I'm going to put equals to. Then I'm going to move to my input page using control page up and moving to the left. Alright, so I use my cursor to move to sales yearly sales growth of 13% in year 1. Now what this means is that sales is growing from the base year to year 1 by 13%. So that means that we need to put we need to say 1 minus, you can open a bracket and say 1 plus that 13% growth, so that it will now be 113% multiplied by the base. So you are going to multiply that by the sales or in the base year. So I move back to the P&L by using control page down. So we'll move to the base year. So I'm applying the base year now. So you can see 7427 is the base year sales. So year 1 sales is growing by this base year sales of 7427 by 13%. That's why we are adding 1 plus 13%, which is going to give us 1.13 or 113% times the base year sales. So that's how to actually apply your forecast assumptions. All right. So that has been gotten for sales. Then we'll go to cost of sales equals to, then page up, control plus page up. We'll go to the input page. Then the assumption for cost of sales is a percentage of sales. So we're going to apply this percentage, multiply by sales. So our sales figure is the one for the current year, which is 8392.5. And so this gives us that figure. Then to get the gross profit, we just simply put our cursor on the gross profit of the base year, then hold shift and forward arrow once and hit Ctrl R. So Ctrl R will replicate that gross profit formula we have imputed here into the first year. Alright, then selling expenses equals to, we go look for the assumption for selling expenses, and it's also expressed as a percentage of sales. So 21% multiplied by the sales of that year. So control page up, sales of that year is 8392.5, and so you got your selling expenses for year one. Then the operating profit, just extend shift forward arrow control R. Right, then the taxes equals, go to the input page. Taxes is expressed on PBT, so this is the tax rate multiplied by PBT. So PBT in this case is our operating profit because we've got no finance costs. So operating profit, which is earnings before interest and tax, is also the same thing as PBT. So I'm going to multiply that with that. Then our net income, I will extend this, Ctrl R, and that will give us the net income. So let's move to the balance sheet side to also carry out the forecast for year one. So balance sheet segment, the first item we have under the balance sheet is cash. Now the principle here is that cash is always forecast last. In fact, cash is the balancing item in your balance sheet, which is actually is determined by the forecast in the cash flow statement. So the balance in the cash flow statement, or the ending cash balance in the cash flow statement, is actually interlinked to serve as a balancing item in your balance sheet. So we are going to leave this part blank. We're going to leave it blank now. So we'll move to the next item, which is current assets. So year one forecast for current assets equals to, I go to my assumption page and I look at the assumption for current assets is applied on sales, a percentage of sales. So 32% multiplied by sales. Sales can be, you can get sales in the P&L account. So this is sales of year one. Now one of the issues when building forecast is wrong linking. So you should be very careful as to the period with which you are linking to. Alright, so that gives us our current asset forecast. Then I extend the total here to year one, Ctrl R. Alright, then fixed assets. Fixed asset equals to, we'll go look at the assumption for fixed assets, and that is Naira growth. So this is the growth on fixed asset, and it is in absolute terms. So it's going to be this figure plus the base year figure. So I'm going to get the base year figure for fixed asset. You can find that in the balance sheet. Control page down to move to balance sheet. Then balance sheet figure for the base year is 7815. So the Naira growth in the fixed asset plus the base year will give us what the current year figure will be. Then I extend this total, Ctrl R. Next is the current liability forecast equals, go to the input page, look at the current liability assumption base. It is this percentage on cost of goods sold. So I'm going to apply that on cost of goods sold. Cost of goods sold can be found in our P&L. So cost of goods sold is this. For the current year, year 1 is 5790.8. So I hit enter. So that's the forecast for the current liabilities. Then long-term debt equals to, go to the input page to see the assumption for long-term debt, and is a yearly balance. So that figure is what we should have at the end of the year. So it's a direct link to that assumption. So hit enter, and that gives us that figure. Then we extend our total, Control R. Alright, share capital equals, go to the assumption page, look for share capital assumption. It is Naira value. So this is the Naira value we should have. This is also another direct link. So we've got that. Then retained earnings. Now retained earnings is usually the balance at the end of last year of our retained earnings had the profit for the year. The profit for the year can be found in the P&L account. So you go to P&L, the profit for the year is our net income. So in this case, we've got no dividend. If we have dividend, we would have subtracted dividend from this before we get our profit to be retained. So that is our retained earnings. Then we extend this, Control R, extend the total liabilities and equity, shift forward arrow, Control R, then extend the audit check, shift forward arrow once, Control R. Okay, so we are having a disagreement of 231 here, 231 in negative. Remember, we left out cash, so it is presumably that will be the balancing figure for cash, so but then before you can determine that, you need to go forecast the cash flow statement. So we'll move to the cash flow statement. The first thing, this is an indirect method for preparing the cash flow statement. So we'll move to net income. Net income is the first item. We can get net income from the P&L account, year 1. Don't forget we are forecasting for year 1. So P&L account, then change in current assets equals, you go to balance sheet, you can see the change in current asset in balance sheet. This is current asset. When current asset is growing, it is negative. It means cash is being tied down outside. So it's a form of cash outflow. So in order to replicate that is cash outflow, it needs to be in negative. So we are going to say the base year current asset minus the current period current asset of 26, so that will give us a negative because our current asset is actually increasing in that period. Alright, current liabilities is going to be an opposite. Current liabilities, so we'll move to current liabilities. So when current liability is growing, it is positive. It is positive, and so we need to say the current value of current liabilities minus the base year value of current liabilities, which is this. So when it is growing, it is better for us because we are keeping in cash. Cash is being kept in and not given out to pay liabilities when current liabilities is growing. Alright, so we've gotten all the items under the operating activities. So we'll do a sum that we've got 478. Alright, then here we have change in fixed assets. So equals change in fixed assets. Fixed assets can be seen or found in the balance sheet. So this is fixed assets. Now the difference in fixed asset found in balance sheet may not just be the additional asset purchased during the period, but also the accumulated depreciation. So you need to be able to differentiate in between what the difference in the fixed asset is for the depreciation as well as for the actual acquisition during the period. But for this simple scenario, the only difference in these two is for the purchase of assets that we saw, because here we did not consider any depreciation in this simple model. Alright, so in order to show that acquisition of fixed asset is cash is going out of the company is going to be the base year minus the current year. The base year minus the current year, so that when it is increasing, it's showing that cash is going out. Alright, that's the only item we have there. Now, under the cash from investing activities, we could also have investment in subsidiary, investment in shares, and the rest of it. Alright, but this is in fixed. This is the only one we have here is in fixed assets. So we'll do a sum of the cash flow from investing activities, which will give us that value. We are concentrating on year one. So for under financing activities, we have change in long-term debt. So equals, go to your balance sheet, check your long-term debt. Long-term debt. So change in long-term debt. When long-term debt is increasing, it means money is being tied down, but when it's decreasing, it means you're actually reducing your debt by paying. So in order to show that, it needs to be the current year minus the base year. Current year minus the base year. So this shows that some debt are actually being serviced, being paid. So that's why we're having a cash outflow of 316. Alright. Then change in share capital equals, go to your balance sheet, share capital. Share capital will also go in the same tune with some long-term debt, because when share capital is increasing, it actually means that shares are being issued and money is coming in. So, but when share capital is decreasing, it means there is the redemption of shares. So we need to say the current period less the base year, to show that increase or decrease in share capital. Right. So we've gotten to all the items under financing activity. So we just need to do a sum. Sum that. We've got that. Then cash generated in the year. That will be a sum of cash flow from operating activities, cash flow from financing activities, cash flow from investing activities, and from financing activities. So those three items. Then we've come to our cash balance. Now you need to link the cash balance for the base year. The base year cash balance needs to be linked to this portion of the cash flow. So I'm going to link it from our balance sheet. So let's go equals to, then go to your balance sheet. This is the cash balance at the base year, the historical year, the last historical year before the first forecast year. So I've linked to that. Now, in year one, that will be our opening balance. The ending balance of the base year cash will be the opening balance of the first year. Alright. Then cash generated in the year is equal to this figure, which is an addition of cash flow from operating activities, from investing activities, and financing activities. Alright, so we've got that. Then we'll do a sum to get our cash at the end of the year. Do a sum, and so you have 231. Now let's go back to our balance sheet and link this ending cash balance to our balance sheet here. So equals, go to our cash flow statement and link to cash at the end of year 1, 2, 3, 1, and see whether this balance sheet will balance. So that is it. The balance sheet actually balanced. So you have passed the first step, the second step, now the third step. So the third step is to ensure that your inputs have been stated for year 2, have been stated for year 3, year 4, for the number of years you want your forecast is actually going to be for. So you have established all the assumptions for those periods. Even though your P&L has not been forecast for year 2 to 5, your balance sheet has not been forecasted for year 2 to 5, your cash flow statement has not been forecasted for year 2 to 5, but your assumptions have been stated for year 2 to 5. Now, the simple step is just to replicate what you have done in year 1 of the forecast year to the other year. So this is how to replicate. Highlight by holding shift downward arrow to highlight down, then shift forward arrow to highlight to the right, then hit Ctrl R. So that replicates it. Then go to your balance sheet as well. You also need to replicate your balance sheet that way. So I'm going to start with this and highlight it up to cash, and shift forward arrow, Ctrl R. Now you see that my balance sheet is not balancing, but then let's go to replicate the cash flow. So for the cash flow as well, highlight everything, shift forward arrow, Ctrl R. So having done this, your balance sheet should then balance. So you can see that our balance sheet is now in agreement for those years. Our balance sheet is now in agreement for those years. So that is how to actually carry out a forecast. This is how to carry out a forecast of the P&L, the balance sheet, and the cash flow statements. This is a simple financial model. Now the implication, what we have done here is that we have been able to build an integrated financial statement model. What do I mean? The input here can be changed. Scenarios can be applied on this input, and then our balance sheet will still be in agreement. Let's take, for instance, year 1 percentage growth rate is changed from 13% to say 50%, and see your and take a look at your balance sheet. It should still be in agreement. You can see. So the implication of increasing your yearly growth in year 1 from 13% to 50% can be felt in your gross profit, can be felt in your operating profit, can also be felt on your net income. So those are scenario analysis, sensitivity analysis that can be carried out on this particular model. But then that will be for another webinar. So thank you for staying tuned to GEM Financial Modeling Academy. So bye.